Welcome everyone to another episode of Wolfe Street. For those of you that don't know, my name is Wolfe, and for those of you that do, thanks for checking me out again. You can check me out on all social media platforms at Every Time I Cash. This video and all my videos are for educational, informational, and mostly entertainment purposes only. They're not to be substituted as financial advice. Talk to a financial professional, build out a plan, do it the right way. Don't just YOLO on the back of internet videos. This is going to be a video kind of like catching up on where we are versus where we were, and there's a lot of hot topic, hot button, buzzwords that we're hearing, primarily around the 2 and 10 year inversion. And so this video is going to primarily talk about that. It's going to be a quick one. Please, if you like the content that I put out, hit the subscribe button on this channel. Hit the like button, leave me some feedback, even if you don't like it. I'd greatly appreciate it. So I'm not going to take up too much of the time, and we're going to jump right into it. First thing I want to start with is just the overall market and where we are, where we were, and where we're possibly going to be going. This is just the S&P 500 on the back of a 1-year basis. And I just want to highlight a couple of things, just to kind of give a little perspective. I like to start here. I know that charts by and large are astrology for men. I like to know what my astrological signs are before I start to, put together some pieces around it. I don't like to create confirmation bias. So let's start there. And also I don't like to kind of find implicit bias, but I like to know where we are, where we were, and just kind of give some scenarios before I build out like what could possibly be bringing us here. So first and foremost, we broke out of 4,000 last year. This is in April of last year, April Fools, like we are right now. And we basically, on the back of this 1-year rally, we had a rally, and every time it checked this trend line, it held. This happened until mid-January, so January 20th, we broke down. We came back, retested, failed the 100-day, retested again, and then we broke down. If you notice, this is kind of an important thing to kind of like pay attention to, because from a technical perspective, there are technical traders. So even if you don't believe in this stuff, there are people that do, so they can create some sort of selling pressure around important levels. And that's kind of like what we've been seeing. We had a retest of this trend line that we had for the better part of a year, and we failed. So we had a rally that started in mid-March. It started on the back of the Fed, and we just kind of like took off like a bat out of hell for the better part of 2 weeks before ultimately failing at this like 4,600 level. This 4,600 level basically coincided with the selling point that we had back in January, the failure zone back in February, and February 2nd and February 10th. It also kind of just got a little bit above it and retested that prior trend before failing. So this is the S&P 500. I also like to look at the NASDAQ, and I like to use the futures just because it's rolling. Essentially kind of the same thing. The NASDAQ was in a wedge, if you want to call it that. Downtrend, if you want to call it that. Doesn't matter how you look at it. You can draw the lines however you want. But essentially, the NASDAQ held its 13,000 level that it held back in May of 21. And from there, it just rallied in a straight line until it tested its 100-day, and now it's beginning to roll over once again. So this is just kind of like a general overarching like understanding of where we are from the perspective of the market on a technical basis. And I like to have this in the back of my mind, just so I can kind of understand where we were, where we are, and from a technical perspective, where we could possibly go. So if we were to break out above this 100-day moving average on the NASDAQ and it starts to provide support, there is potential for us to go back to a prior all-time high. We could just highlight it here at this 15,700 level. This level also coincides with where the market really started to break down back in mid-January of this year. So we really once we broke down this 15,700 level, we really started to capitulate to the downside. And so this will probably give us a little bit of resistance on the upside if we were to reclaim this 100-day. Let's highlight it here. On the back of the NASDAQ. So that's just from a technical perspective. And this is important because the majority of the top stocks in the market reside in the NASDAQ. So the NASDAQ is by and large a good indicator for how some of these stocks might perform, how the overall market might perform. And this is important to know on the back of, or ahead of, earnings season, which should kick off here in the next couple of weeks after we get you know, some Fed minutes tomorrow and some more Fed commentary in the next couple of days. So this is an important juncture for the market after a very impressive rally, and it's kind of important to understand and know where we are and where we were and where we could go. All right, so let's just roll back into this. Moving along, the screen in front of you is going to say elasticity. It's primarily talking about the snapback rally that we just had. Is the rebound for real, right? So we just went over some of the technical perspective of the market, like where we were, where we are, where we're going to go potentially. And so when we look at that, we want to understand, is the market for real? Is this rally for real? Are we buying this rally? Are we selling this rally? Or are we going to fade it? So from a technical perspective, generally speaking, if we are in a bear market, which a lot of tech was in a rolling bear market, these snapbacks are violent, quick, fast, and in a hurry, and in general, they fade, right? So the key structural component of a healthy market is you get a broad base and you get some buying, and it accelerates over time, and then you get a bearish to bullish reversal. We haven't had that yet from a technical perspective. It's not to say that we won't get it, but we haven't had it yet. So my inclination here is, from a technical perspective, that this is something that's going to fade over time here in the short run. Now, the key for the entire market is that the market moves in the direction of earnings. So this is not necessarily the revisions. On a short-term basis, we might move that way, but in general, the direction of earnings. So if earnings are positive from a growth perspective, and they continue to be positive, the market in general will follow. So this is an important thing to remember, because as we start talking about the yield curve, we start talking about the Fed, we start talking about all these things that could potentially disrupt earnings growth. It's important to note these things, because as long as earnings continue to grow, the market in general will continue to grow, right? So the market will move in the direction of earnings, and it will move. That direction of earnings is driven by the availability of money, which is driven by the Fed's dual mandate. And this is something that we are going to constantly hear about in the next couple of months as the Fed continues to tighten, and in this video, because the dual mandate is the primary function for why the Fed is going to tighten and needs to tighten, right? And so as the availability of money continues, and it's going to keep earnings going in the same direction. And as the Fed has to combat its dual mandate, which is to keep inflation down and to keep employment at peak employment, or as close to peak employment as you can get, they're going to be boxed in. They're going to need to continue to tighten. And so the whole thing comes down to, this entire market is going to come down to whether or not the Fed can continue to support earnings growth, or whether or not they have to act so aggressively that it's going to slow down the opportunity of money, and it's going to shut the whole frickin' thing down. So that's essentially, in a nutshell, what we're gonna have to focus on and think about and keep in the back of our heads moving forward. So as long as the Fed doesn't disrupt earnings growth, then we should be in a situation where earnings growth yields a higher market, even though in the short run we might have revisions to the downside, and we might have some chop along the way. So that's ostensibly the entire thing. I'm not saying here that, we're not going to go into a recession and the Fed is going to nail this thing, but anybody making a bet on a bullish bet on the market is going to need to keep that in the back of their mind. As long as the money is available, and as long as the Fed could land the plane, even if it's a little bumpy, as long as they can land the plane, market in general should continue to go up after all of this kind of subsides. So, moving along, the first thing we got to know is, the definition of a yield curve. It's on your screen. You can read it. But essentially, the price of a bond inversely correlates to yields. So in a healthy market or healthy economy, the Fed raises the short-term interest rates, yields, to rein in borrowing. And by doing that, they limit inflation. So that's like they pull a lever. They often say they're going to use their tools, right? So this would be one of their tools. They pull a lever, and this lever in this case would be raising short-term interest rates, and that reins in borrowing, which by proxy should limit inflation. So when things like this, like when the Fed starts taking actions like this, it often will have an impact on investor sentiment, and it kind of becomes a self-fulfilling prophecy in some respects, right? So when the economy is good, investors don't want to take out of excuse me. When the economy is good, investors will typically take money out of longer term maturities, and then they'll use that money for better returning assets. So in general, they don't want to put their money in safe stuff. They will want to put their money in aggressive things like, Tesla, for example, risk assets, et cetera, et cetera. So essentially, when people don't know what's going to happen, they want to take their money out of the market. They want to take their money out of stuff that's risky. They want to put it in stuff that's safe. And simultaneously, if inflation's happening, the Fed will want to raise short-term interest rates. And by and large, that flattens the curve. So that's constant. That's kind of like what it is that you constantly hear about. And you can read these definitions right on your screen. But essentially, the thing you have to take away from this is the price of bonds and the yield curve have an inverse relationship. So if the price of bonds goes up, yield curve goes down, and vice versa. So they're inversely correlated, and that's something that you need to keep in the back of your mind. So treasury yields, right? So what are treasury yields? Again, please you can go ahead and read definitions. But the important thing here to remember is, why do we even care about a yield curve? So, and why do we look at a yield curve to begin with? So we look at a yield curve, and we use the yield curve because ostensibly it's the difference between what a lender can get for their money, or what a lender can get their money at, and what they can make by lending it out. So as the yield curve gets flat, people are disincentivized, and in this case, people are banks and money lenders, are disincentivized from lending money out. So ultimately, if a yield curve flattens and banks or lenders can't offset the risk of delinquency on that yield, they just won't lend the money. And so, as you have flattening of yield curves, you have more people becoming more risk averse, whether it's investors, pulling their money out of risk assets, or whether it's people who want to lend the money, pulling back the reins on lending that capital. So that's like a primary, the primary thing here that you want to pay attention to, or that I pay attention to on the back of, this yield curve talk, right? And so the focal point that we've heard in the last couple of weeks is that there is a turn happening. So the 2-year and 10-year yield curve is inverting. So historically, the yield curve inversion is every bear's wet dream. Generally, that inversion kind of predates a upcoming recession. And like I said a little bit earlier, sometimes this becomes a self-fulfilling prophecy. People kind of rein things in, and it becomes a chicken and egg question, right? However, and I'm going to first on the next slide show where these yields are on a 10-year basis. But however, it doesn't mean that it happens instantaneously, automatically, and it's all doom and gloom from there, right? So here is your treasury yields for the last 40 years plus, right? So we've had a 4-decade downtrend, and we're pressing up against, the top end of this downtrend. And, when you see that on a 10-year, this is the 10-year yield, right? So when you see that happen, when you see us pressing up against this trend, is there a chance that we break through this, and then for the first time we can create in a long time we can create some real systemic pressure in equity markets and in on an economic basis, right? And so this is going to be the important thing to see from the 10-year yields perspective, and from 10-year yield notes. If we can just roll back over, then it's from the upper left to the lower right, and we get a scare, and we move forward, and we move on. The second thing to keep in mind now on the back of this is, every time, like I said, every time the yield curve dips below zero, historically, a recession is followed. So this is the last 8 times on our screen. You can see the last 8 times here in this table. On average, this happens with about 18 months after the inversion. So you get an inversion, get about 18 months, and then, you know, that lag generally isn't all doom and gloom in that meantime, right? So if you take the last 8 times you saw yield curve inversion, only one other time, and this would be this right here back in the 1970s. So there's only been one other instance than this instance. So this instance that we're in right now would mark instance number 2. Sorry, I said that a little bit complicated, but essentially we're in an instance currently where there's only one other precedent for that, and that was 1973, where the peak of the market happened before the inversion. So in 1973, you had the inversion date as March 30th, 1973, but the peak of the market was January 1st, 1973. So currently, we had a peak prior to our most recent inversion, and so this would make instance number 2 of that scenario happening. So historically, you get about a 17.7% return before you have a recession that takes hold of the market. So, and this, again, the median amount of time is about a year and a half. But currently we're in an instance where, you know, we just had a little bit of an inversion, and is going to be an instance where the market kind of, you know, just rolls over and sells off, and we never make a new high? Or are we going to just simply be, you know, in a situation where the inversion has happened after we had a peak in the market? And so the one thing to kind of remember here is there is a canary this time around that we haven't seen in the last, you know, 20 years plus, right? And this is the US break-even 10-year inflation expectations have actually broken out. So all you got to understand out of this, or all we have to understand out of this, is that generally speaking, the more hawkish that the Fed has been, the more inflation has come in, right? And this is an instance where no matter how hawkish they've been from a vocal perspective, and no matter how hawkish they've been, or they are currently, they can't seem to bring in inflation expectations, right? And so this generally will signal that they need to be a little bit more aggressive to bring back in these inflation expectations to the normal. And so when we think about this, and when we understand this, this can only lead us to understand that the Fed has to honor their dual mandate. They have to rein in inflation, so they have to, no matter what they're boxed in, they have to, you know, continue to raise rates to offset inflation, and it could signal that they have to be more aggressive in order to do so. So, you know, I know on the previous tab here, so let's just go back. I know here we're looking at a situation where, you know, like I said, there's been an average of 18 months before you had a lag, and, you know, the market has been higher by about 17.7% on all those times before you had the recession kick in. But that doesn't really take into account the last, you know, 20 years or so. So in this instance, you've had multiple recessions in the last 20 years. So you had 3, and then you had one in 1990, and then one in 1980, et cetera, et cetera. So when you look at this, you know, half those instances on that screen, you know, came when you had US break-evens not break out, right? So we have to keep this in the back of our mind, because this could potentially give a situation where the Fed has to be more aggressive because they're behind the curve, and they have to act more aggressively, which in turn could spark a recession more quickly than people would like, and then what people would want, right? And so, you know, since we don't have to occupy ourselves, let's just assume that we don't have to occupy ourselves in the short run. Like, let's just assume that the general history of the way things have worked will continue, and the Fed's able to kind of like manufacture some time and buy themselves some time, and we don't actually, you know, invert very quick. That the inversion that we just had doesn't actually lead to a peak market before we had the inversion. Let's just make that assumption, right? So let's look at a table and understand, like, historically how it's been and where we've been, right? So here are all of the instances that we've had, where the market itself rallied the way that we rallied back in early March, right? And so on this chart, when we take a look at it, in all of these instances, right, you've had multiple times, even in the year 2000, where you had the recession happen and it was 21%. That's the one instance where we had a recession happen and 21% sell off in the market 1 year later. Even in that situation, you had a 1% gain 3 months after that instance of a 6% rally or more in the course of 4 days, and you've had 6 months out, it was still basically flat, right? So the precedent here is that by and large, we have gains on the back of what we just saw, and by and large, those gains are materialized, 6 and 12 months later. So you can, again, take a look down here. On average, 6 months out, you've got a 14% return, and on average, 12 months out, you have a 24% return. And so when you take these into consideration, when you think of these things, in general, this bodes well for a potential market where we do have some choppiness, and we do have situations where, like, the Fed's going to have to try to rein in inflation. The Fed's going to have to act more aggressively than they want to. The Fed's going to have to honor their dual mandate. But by and large, it gives you situations that as long as they can, kind of hold down the fort just enough and not push us too far into a recession, and we don't get pushed too far into a recession, it will give us an opportunity to really, load up on stocks, load up on risk assets on the back of it, and as things normalize, really accelerate for further gains. And this is essentially goes back to the beginning comment, right? So again, the action in the market is, totally dependent on the direction of earnings, right? And that direction of earnings is totally dependent on availability of money, and the availability of money is totally dependent on the dual mandate. So as long as the Fed can honor their dual mandate, as long as they don't tilt us into a recession, I know there's a lot of as long as and a lot of caveats here, right? So as long as these things happen, you could see some, tumult, like, on your screen here in 2008, we had serious tumult, but then it resulted 1 year out, you had an 8% return, right? So you could see tumult, you could see, some choppiness back and fills, but in general, as long as these narratives don't change, as long as accessibility or access to money doesn't change, as long as the Fed doesn't have to act so aggressive that it puts, lending in gridlock and, the availability of money in gridlock, as long as there's not World War III, as long as there's so many things that I know there are so many dark clouds above us, right? Then we can get situations where selling creates opportunities for us to leg into for a intermediate and longer term outlook, whether it be 6 months, 1 year, whatever, right? So what we want to see is the same thing we've been seeing all year. We want to see these aggressive whooshes to the downside. You want to see it's panic, end of the world. Oh my God, what's going to happen? And then it gives you an opportunity to just buy the dip on a short-term basis once you have all of these extreme indicators kind of light up. And then that gives you an opportunity to buy the dip for a little bit of a bounce, right? So I know I said a lot of positive things here. I'm not positive. I'm just being a little bit optimistic and a little bit neutral, but I'm not positive. I'm not in the camp that says that this is going to end well potentially, but it's important to know where we were and where we are and some of the things that could happen. Now that we've gone over the different scenarios of where we could potentially go, how things could play out, some of the positive stuff. And how inflation is going to be an issue. We also need to understand that there are other issues and there are other factors at work with the market. Primarily in this instance, we have supply chain issues, right? So we still have issues of supply chain, and this comes on the back of the Russia-Ukraine situation, which is already increased and is going to increase crop prices and limit some crop to European countries, and I'm assuming the rest of the world. We also have Chinese lockdowns on the back of COVID that keep popping up left and right, and we continue to see bottlenecks in the face of pent-up demand. So we've had people locked in for 2 years. They're ready to get their lives back up and going. They're ready to get moving. They're ready to do all this stuff. They've got some pent-up demand, and then, COVID happens in China. They shut down, and then now we still don't have cars being manufactured the way they should be manufactured. We still don't have, if you order a MacBook, like I ordered a MacBook, it took about 8 weeks to get to my house. So we still have a lot of constraints that we're dealing with, and we still have rising labor costs. We still have rising material costs, and we still have inflation, like I said on previously. So these constraints are only adding to the inflationary issues that we're seeing. And these issues, these supply chain issues, if not reversed quickly or a little bit more quickly than they've been going, they could remain persistent, which would also create a feedback loop for the Fed having to act more aggressively yet and still, right? So we get this instance where we have the Fed trying to combat inflation while using all the data they potentially have. And obviously, we all know that the data that they use is maybe outdated, or maybe in some instances incorrect, or maybe in some instances lagging, right? And so as they're trying to combat this inflation narrative and they're starting to deal with other issues, we also have supply chain issues that are contributing to these issues. We also have asset price increases that are contributing to these issues. And so you get this feedback loop where the Fed has to act more aggressively to offset. And then by them acting more aggressively to offset, they actually kind of hurt things, because they could be, towards the tail end of these supply chain issues, or towards the tail end of these issues that, kind of put us in a situation where things could potentially be rosy, right? So like, they could be acting at the tail end of, peak global COVID. They could be acting in the tail end of, peak supply chain constraints, so they can offset this inflationary pressure that just won't go down. And then it could just kind of be too late that they're acting or they're doing this stuff, because we're in the last inning, last out, whatever, right? So it's important to know this stuff. That's kind of how I'm looking at it. I, again, remain in the same kind of blueprint that we've had all year, which is we're gonna get these aggressive sell-offs, and as long as the narrative hasn't changed, and as long as things haven't changed, and there's access to credit, access to money, access to capital, et cetera, and the Fed doesn't do anything too drastic, it's going to give us an opportunity to buy the dip and to really take off from there, right? And so let's just go to a couple of charts, just kind of put some names behind it. So like this, again, same kind of, how do I remove this? Remove drawings. All right, cool. So the same kind of logic here, right? So if you take a look at Tesla, you had, in this instance, move this. You have a 50% rally, right? And in this instance, on the back of a sell-off, you get a 35% rally. And again, in this instance, you get a 50% rally, right? Give or take. I'm just ballparking it here. So when we get these sell-offs, we're going to get opportunities, right? And so we're going to want to act on the back of these sell-offs. We're going to want to act, and let me go back here actually and make it more even. So maybe not 50%. It's probably around 40 or 35. Yeah, so 39%. So you're going to get these opportunities, and we're going to get these opportunities to, take advantage of drastic sell-offs and have oversold conditions. And if you just do this real quick, from the peak at the start of the year, January 4th, let's zoom this over, from January 4th to, the trough here that we had on February 24th. So basically you get 2 months. In 2 months, Tesla lost 42% of its value, right? And it's crazy, but these present opportunities. So whether you're shorting, let me delete this, whether you're shorting to the downside after these moves, or whether you're taking advantage of these opportunities to the upside, you know, you're going to have these opportunities in some of our favorite names and some of these names that we're accustomed to trading, where you can, you know, buy the dip or sell the rip. And so in Tesla's case, for example, I brought it up just to kind of illustrate a point here. But in Tesla's case, here you go. Here's your top here. Oop, why is it doing this? Here's your top here, and then we go, you know, move it over, and then you'll have, here's your top here, and then again, we just had it happen today and yesterday. There's your top there. A nice little downtrend on Tesla. So if we were to get another mean reversion sell-off, and let's say we sold back off to, let's call it 900, which is the 50-day, it's not crazy to assume that we could possibly go back there, right? And let's say you get these aggressive sell-offs and you get this aggressive selling pressure and everything looks dire and the world's going to end for Tesla, et cetera, and buyers step in and buy it back. Well, you know, the same opportunity presents itself. So until these opportunities, until these scenarios kind of stop happening in this way, we're going to constantly have opportunities to take advantage of. I'm going to go over Amazon next. Let me just delete all this stuff and go back to where I was. So I'm going to go back to Amazon. I'm going to go to Amazon next, which is the same kind of thing, right? So Amazon's been in a range, or it was in a range, for the better part of 2 years. On the low side, we would get down to 2,900, and then recently we'd get down to like 2,700, and then see a rally. And so the same kind of concept. Amazon broke its, I think it was like 13-year uptrend. Let's see. Yeah, Amazon broke its 13-year uptrend, and then now that it's broken, what we're seeing is these violent shocks where it goes down, tests that 2,700 level, 2,750, 2,700, finds buyers, rallies back, fails again, right? And so in every instance here, I'm showing it here, this was a breakdown point on Amazon. And in every instance, we've come back to test this trend. The first instance was in early February, and then now in March, we failed. And so there is a potential that Amazon rolls over here with the overall market and with Tesla and all that stuff. And there's a potential that it goes to 2,700 again in a straight line like it did the last couple of times, or maybe it gets to 2,800 or 2,900 this time and finds buyers. But there's potential that this stock and stocks like this continue to have this back and forth, this tug of war where, you know, everything looks like it's dire and the world's going to end and no one wants to own it. And then you get right back to the edge where it's like, okay, everything's great. And then it fades again, right? And so what you want to do, and what I've been doing, is positioning myself for, you know, these sell-off moments and these oversold conditions. I like to use, again, the rate of change on the 5-day, 10-day, and 50-day moving averages. And I like to see the percent of stocks above their 10-day moving averages and 50-day moving averages. And when we see these extremes on both sides, whether it be above their 10-day and 50-day moving averages, that's the time for me to pump the brakes. And then on the flip side, when they're extreme to the oversold condition, that's the time to kind of like leg into these things. And it doesn't need to be much. And then when we get these violent rallies like we've had, they tend to happen in like a month's time tops. And in several cases, they happen in like 2 weeks. You know, by the week and a half point, I'm pretty much unloaded for the most part. And again, rinse, repeat. If you're one of these people that likes to short into these events, same kind of concept, right? So you get these oversold conditions to the downside, cover. You get these overbought conditions to the upside, try it again. And I think we're going to keep having these fits and starts and back and forth moments when we continue to have these times of uncertainty. And so that's kind of like how I'm playing it. That's kind of how I'm thinking of it. Other things I want to pay attention to, though, I want to pay attention to like the actual, whether it's indexes, whether it's ETFs, whether it's sectors. I want to pay attention to actual individual sectors and see how they're performing. So in this case, you know, the SOXX index, which is semiconductors, it's struggling with its 100-day moving average. And so when I pull up things like AMD, struggling with its 100-day moving average. I pull up NVIDIA, right? It should be struggling to stay above its 100-day moving average. And so that's kind of like the logic that I'm having. And it's kind of like, again, here's Micron, struggled with its 100-day. It's kind of like the logic that I'm having. And I know, not all chips are in the SOXX, some of them are in others, but like you can just go across the board and you'll see the similar price action, right? So I want to pay attention to these things, and then I want to find certain stocks that don't necessarily behave in that way. So Intel's one, for example, because as soon as these things potentially turn for the positive, the ones that have been moving on their own, whether will probably continue to do so. And if you find one that is outperforming, I'm not saying Intel's outperforming here, full disclosure, but if you find one that is outperforming, in this case, let's use a Vago. Generally, that'll be the one that will outperform the sector in general. So that's kind of how I'm thinking of it. That's kind of like the logic that I apply to it. Want to find these types of stocks that are outperforming their cohorts and their sectors, and want to find oversold conditions to leg into and overbought conditions to sell out of. It's I know it sounds super simple. It's not. I'm not pretending that it is. But that's essentially the game plan. That's essentially how I've done things. So with all that said, I know this has been 30 minutes. I thought it was really important. I want to say thanks for watching. Thanks for your time. Please leave me a comment, like the video, subscribe to the video if you can. I'd greatly appreciate it. Leave me feedback, positive or negative. I'm really appreciative of it all. And without further ado, please stay safe, stay profitable, and as always, stay locked